The market just taught us something profound about human nature. While everyone focused on Greenland tariffs and Netflix earnings, the real story was happening beneath the surface, a systematic transfer of wealth from the emotional to the disciplined. This week revealed exactly why markets remain exploitable and why most participants will continue funding those who understand the game. Tuesday's sell-off pushed all major indices to their worst performance since October. The VIX spiked above 20, financial headlines screamed crisis, and retail investors hit the sell button. Yet by Friday, the Nasdaq had recovered to positive territory. This isn't coincidence, it's human psychology operating with mechanical precision. The same fear that drove Tuesday's panic created Wednesday's opportunity for those who remained calm. Here's what actually happened beneath the headlines. The Greenland tariff announcement triggered immediate loss aversion, not because investors believed in military conflict, but because uncertainty itself became the enemy. Humans consistently overweight low-probability, high-impact events. When Trump announced 10% tariffs escalating to 25%, participants didn't calculate probabilities. They imagined worst-case scenarios and sold accordingly. Meanwhile, systematic rotation was occurring that most missed entirely. Small caps outperformed large caps for the 12th consecutive day, the longest streak since June 2008. This wasn't random. Capital was hedging concentration risk after watching Magnificent Seven names stumble despite elevated valuations. Intel collapsed 17% on weak guidance, while Nvidia gained on China chip speculation. The market was teaching the same lesson it always teaches. Individual stock risk remains asymmetric even in bull markets. The system absorbed this geopolitical shock and repriced it within 72 hours. This V-shaped recovery pattern has become dominant market structure, conditioning participants to buy dips aggressively. But here's the critical insight. Each successive dip requires faster buying to prevent cascading liquidations. The VIX futures remaining in contango signals. Institutional players are pricing elevated uncertainty for months ahead, even as spot volatility compresses. Bond yields surged to 5-month highs before stabilizing, reflecting competing forces of fiscal expansion and Fed policy uncertainty. Gold hit fresh record highs while equities recovered, showing participants are hedging tail risk even as they chase returns. This creates a barbell structure where both defensive positioning and cyclical value attract flows at the expense of rate-sensitive growth. The semiconductor divergence crystallizes the system's current logic perfectly. Intel failed because it couldn't articulate competitive parity in AI infrastructure. Nvidia gained on regulatory speculation. AMD strengthened on duopoly expectations. The market is pricing supply chain dynamics and regulatory frameworks as equally important to technological capability. This is second-level thinking in action. The Stoic approach recognizes this chaos as opportunity, not crisis. Those who sold Tuesday's panic locked in losses based on headlines rather than probabilities. Those who bought the dip were rewarded not through prediction, but through understanding that extreme moves create mean reversion opportunities when fundamentals remain intact. The rotation from growth to value isn't bullish or bearish. It's the system rebalancing after 3 years of concentrated outperformance. What matters isn't which regime persists, but whether your process adapts to both environments without emotional interference. The Fed chair speculation and credit card rate cap demonstrate that policy uncertainty is now permanent, not temporary. Markets requiring certainty will struggle. Markets operating within probability distributions will adapt. The technical picture shows support levels matter more than resistance, characteristic of late-stage bull markets where dip buying remains reflexive, but breakout conviction has weakened. The S&P holding above support while struggling with resistance creates defined ranges for tactical positioning. Volume patterns suggest institutional flows are becoming selective, increasing the importance of stock-specific catalysts over index momentum. This environment rewards anti-fragility over prediction. Portfolios constructed to benefit from volatility rather than merely survive, it will compound advantages systematically. The system teaches the same eternal lesson. Edge comes from process discipline, not narrative prediction. Those who internalize this truth extract value from chaos. Those seeking comfort and certainty get systematically exploited by those who embrace disorder as opportunity. The crowd reacts emotionally to headlines. The disciplined remain focused on probabilities, process, and the predictable irrationality that creates persistent edge in human-driven markets. If you value systematic thinking over emotional noise, subscribe for the psychological edge that separates consistent performers from the crowd. The complete framework for exploiting human irrationality is available in the description below.